Welcome to the July 2026 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. And so, if you find today's discussion valuable, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and why it matters. And I'll tell you, this month, I want to start off with a simple reminder. The market can be up and still not feel the same for everyone. And that is why investors right now, they've got to look under the hood. Because if you only looked at the headline numbers, 2026 has looked pretty strong. The S&P 500 has been making new highs. And S&P 500 earnings are expected to increase roughly 24% this year. But then underneath the surface, the story has been much more selective. So let's jump in. Look at this first slide. Through the end of June, emerging markets were up 24.2%. U.S. small caps were up 22.6%. Mid caps up 17%, and large cap value was up 16%. International stocks kind of lag behind, but they're still up 14%. But meanwhile, the U.S. large caps were up 10%, whereas large cap growth, what's been working so well over the course of the last couple of years, was only up 5.1%. You know the Magnificent Seven that we've been talking about? Down 2.5%. So plain English, leadership has definitely rotated. The old leaders have not disappeared, but they're starting to become laggards in the market. This is evidence that the market is up, but it is not equal. Now look at the best performing stocks in the S&P 500. As of June 19th, the top of the leaderboard was dominated by companies tied to the AI infrastructure build-out. Look at the top ones. My God, SanDisk up 820%, Western Digital 333%, Micron at 298, Dell up 228, AMD 151%. But when you zoom in, 19 of the top 20 performers were tied in some way to AI infrastructure. That tells you what the market has been rewarding. It's memory, it's storage, it's semiconductors, data centers, equipment, networking, and infrastructure. You may have heard us say this before, but this is kind of like the picks and shovels behind the AI boom. Let's go to the other side. Look at the worst performing stocks in the S&P 500 and look at the bottom. You see names like Intuit, Accenture, The Trade Desk, Salesforce, GoDaddy, ServiceNow. But then zoom in a little further. 13 of the 20 worst performing stocks in the S&P 500 this year were software and related services companies. So saying that tech is doing well, that's not specific enough anymore. It's just not. The market has rewarded companies helping build AI infrastructure while questioning companies that could potentially be disrupted by AI. And that is what you call dispersion. The gap between winners and losers is getting wider, even inside the same broad sector of technology. The takeaway is not to chase the top performers or abandon every laggard. The takeaway is that investors must look under the hood before drawing conclusions from the headline index. We've said this before, the S&P 500 could near all-time highs while the drivers of performance, the pockets of risk, and the areas of opportunity have changed underneath it. So that's a perfect lead-in to Ryan's market fact. Because as important as it is to understand what is happening underneath the market, it's just as important to keep the longer-term picture in mind. And so this market fact that we're going to talk about today, it's about perspective. And I want you to take a look at this chart. It's incredibly simple, but I think it's one of the best illustrations of the long-term investing that you will ever see. Because what you're looking at right now is the growth of $1 invested in the S&P 500 beginning in 1989. Today, that $1 has grown to roughly $46. That's an incredible return by itself, no doubt, but that is not what I find most interesting in this chart. What I find most interesting is everything that happened along the way. Because across this chart, you're going to see headline after headline after headline. Look at that. The Gulf War, the Asian financial crisis, 9/11, the Iraq War, the dot-com collapse, the global financial crisis, COVID-19, the highest inflation in decades, Russia's invasion of Ukraine, tariffs, and most recently, the conflict with Iran. Yet, when you zoom out, those events become chapters in a much bigger story. Because while the headlines changed, one thing remained remarkably consistent. Businesses adapted. The economy evolved. Innovation continued. Corporate earnings, they grew. And over time, markets kept moving higher. Now, that's not to say every event was insignificant. Some created recessions. Some caused bear markets. Some took years to fully recover. But history reminds us that uncertainty has never been unusual. It has actually been the normal state of investing. And I think that is one of the most important lessons we can learn as long-term investors. And that sets up the big discussion that we're going to have really well, because one of the biggest questions investors are asking right now is pretty simple. If the headlines still feel uncomfortable, what is supporting the market near all-time highs? And so for this big discussion this month, let's take that question head on. And let's kind of dissect it a little bit. How can the market be near all-time highs when the news still feels so messy? This is the question I'm getting from a lot of clients right now. We still have tariffs in the headlines. War risk has not gone away. Oil prices, they've been volatile. Inflation is still frustrating. Interest rates, they still matter too. And consumers are still feeling the cumulative impact of higher prices. And valuations, they're not cheap. So is the market simply ignoring bad news? Not exactly. The market is not ignoring those risks at all, but it's weighing them against the forces that have supported stock prices, which are what? Earnings, interest rates, AI-related investment, liquidity, and the likelihood that the worst-case scenarios actually play out. We've talked about each of these on Let's Talk Markets before, so let's look at what's been supporting the most current rally. So first of all, we start with the new high backdrop. The S&P 500 reached 24 all-time highs in the first half of 2026. Now, that is the tension. The headlines have not been perfect, but the market has continued to make progress. Now, that doesn't mean the risks are gone. It just means investors have been looking at those risks and asking whether they're strong enough to change the path of earnings, inflation, interest rates, or economic growth. A war headline matters most if it changes oil prices or supply chains, confidence, or profits. A tariff headline matters most if it changes margins or inflation or spending. A rate headline matters most if it changes borrowing costs and valuation math. Markets do not need everything to be fixed in order to move higher. Remember that. Sometimes they simply need the odds of the worst case outcome to fall. And I think it's important to understand we've seen the data reflect positive improvement for many of these questions, which has supported the market recent growth. Now, second, and we've talked about this before, earnings. They're doing a lot of the work. Last month, we talked about one of the oldest truths in markets. Over the long term, earnings and interest rates matter most. Earnings tell us what companies are producing, and interest rates help determine what those earnings are worth today. This month, earnings are the bigger part of the story. S&P 500 companies are expected to report second quarter's earnings growth of more than 20% year over year, and calendar year of 2026 earnings are expected to increase roughly 24%. Now, that matters because stock prices are ultimately tied to future profits. And if companies are still growing earnings at a strong pace, investors may be more willing to look through uncomfortable headlines. But there's an important catch here. Strong expectations, what do? They raise the bar. When earnings expectations are high, companies do not just need to be good. They need to be good enough to support what investors are already paying for. And this is an area where we've seen some of the choppiness lately. Think back to the first slide we shared today. These are exactly the questions investors are asking the Mag 7 stocks and companies right now. And third, AI infrastructure is still one of the strongest engines underneath the market. The market has not rewarded every company simply for attaching itself to AI, right? Think back to what we talked about. Remember Allbirds, the shoe company we discussed a few months ago that announced plans to sell its footwear assets and pivot into AI infrastructure? I'm still scratching my head too. That kind of AI label has not been what the market has rewarded. The real strength has been in companies tied to the physical build out of AI. So think chips, memory, storage, networking, data centers, power cooling, and infrastructure. And this matters because AI is no longer just a software story. It becomes a real economy spending cycle. And the biggest technology companies are spending massive amounts of money to build the infrastructure behind AI. And that spending is flowing into parts of the market that did not lead during the last cycle. And that helps explain the split we talked about in the opener. Some companies are seeing expectations move higher because they help build AI infrastructure, and others are being questioned because AI could pressure their business model. So where does that leave us? The market is not ignoring bad news. It is asking whether the bad news is strong enough to break the earnings story, pushing rates sharply higher, pressuring the consumer, or weakening the AI infrastructure cycle. And for now, the answer generally has been not enough to derail this rally. Now, understand that can change. If inflation reaccelerates, if long-term rates move sharply higher, if credit stress builds back up again, or even if the consumer pulls back, or if AI-related earnings finally disappoint, markets can reprice, and they can reprice quickly. But the lesson is simple. Markets do not need to be perfect, and the news doesn't have to be perfect to move higher. Remember, they need enough evidence that earnings can hold up, rates can stay manageable, and that the worst case outcomes are becoming less likely. That is why discipline matters. Discipline means respecting the strength in the market without ignoring valuation. It means appreciating earnings momentum without assuming it's going to last forever, because it won't. It means recognizing AI leadership without letting one of these themes quietly take over a portfolio. And it means remembering that not every scary headline that we read requires an immediate portfolio change. Markets like this, they don't reward guessing at every twist and turn. What do they reward? Process, knowing what you own and knowing why you own it. And that's exactly the type of environment where a second opinion can be valuable. Because today we talked about a market that's up but not equal. We talked about long-term market resilience through decades of uncertainty. And we have talked about why the market can keep making new highs even when the headlines still feel uncomfortable. And when markets are strong but uneven, it can be valuable to step back and ask, okay, well, is the risk balanced? Is the portfolio unintentionally over-concentrated in one theme? Does bond duration or cash exposure or equity exposure still fit in my plan? And does every position have a clear purpose? And that's why we offer our second opinion service. We've seen firsthand how helpful this perspective has been for friends, family, and clients, and we would be honored to offer that same second look if it'd be useful to you. And speaking of taking a headline and asking whether it actually matters, let's close with something a little bit more fun today. And so if any of y'all know me, you know I like my Disney. And so I thought it would be pretty appropriate with Toy Story 5 out in theaters to talk a little bit about this movie and in Disney. And so I'm excited about this, and this is going to be fun. And so with all of this hype around Toy Story 5, we wanted to use a simple example of how a fundamental investor might actually think through a real-world headline. Now remember, this is not a recommendation on Disney stock. It's just an exercise in how to connect a headline to a business. So, from an investor's perspective, the question is not just, was Toy Story 5 popular? The better question is, how much money does Disney actually make from that success? And is it big enough to matter for a company that's as large as Disney? So let's first start with this. Let's take a look at Disney's size. Their reported total revenue is over $25 billion in its fiscal second quarter of 2026. So that means a 1% move in the total company revenue is about $252 million, right? You see how we got that, the exact math. 25.1 billion times 1% equals 251 million. Now, that becomes the measuring stick. Before asking whether a movie matters, investors have to ask how big the company is and how much revenue it would take to really move the needle. So let's look at Toy Story 5. Toy Story 5 opened with ticket sales of about 312 million worldwide. Now, the latest reports have it near 881 million worldwide, and that's about 404 million here domestically and 477 million internationally. So at first glance, 881 million looks well above the $250 million number we just talked about, which is the amount needed to move Disney's quarterly revenue by about 1%. But this is where investors have to slow down. Box office gross is not the same thing as Disney revenue. Disney doesn't actually keep every dollar from every ticket. Theaters keep a portion, and studios generally keep a large share of domestic ticket sales than international sales, which is kind of surprising. But using rough math, it works out to be Disney keeps about 60% of the domestic box office, and that would be about 242 million. And let's say Disney keeps somewhere between 20 to 40% of the international box office, so not as much, right, like we talked about. So that'd be roughly 95 million to 191 million. If you add those together and the rough amount that could flow back to Disney from theatrical ticket sales, it's somewhere around 337 million to 433 million, and that's so far. But that's before production costs, marketing costs, distribution, and timing. So compared to Disney's $252 million 1% revenue move threshold, Toy Story 5 is potentially big enough to show up in the numbers. But the key is that investors cannot stop at just looking at the headline box office figure. They have to translate it into Disney's actual revenue. Then they've got to think through what eventually becomes profit. And that's the point of this exercise. The headline gets our attention. The math gets us closer to reality. And Toy Story does not end at the box office because Disney can potentially earn from Toy Story through a number of different ways, right? Merchandise licensing, Disney Plus, theme parks, games, cruises, and character-driven experiences. So a successful movie can refresh the brand and create new reasons for families to buy, stream, visit, and engage. And that is the Disney flywheel, right? Content creation actually supports the franchise, and the franchise then can support other parts of the business long after the movie is released. So we hope that was a fun way to think about Toy Story 5 from an investor's perspective. And the point is to show the process, right? It's real-world examples. They're everywhere. A movie release or a product launch, a sporting event, or a trend your kids are talking about can become useful information if you spend a little time asking the right questions. And hey, that what you have is here for us for, right? Because it's taking that headline, it's sizing against that company, and it's following it through the business. Then deciding whether it's worth watching or whether it's mostly noise. And Toy Story just makes the math a little bit more fun. So you got to let me know if you've seen the movie and what you think of it, and if you contributed to those revenue numbers and the release. We're grateful you joined us here today, and we encourage you to share this content with anyone who might find it beneficial or fun, and anybody who wants to stay connected to what's happening in the markets and why it matters. We have the replays of all of our Let's Talk Markets posted on our YouTube channel, and so if you haven't checked it out yet, you definitely should, because it's home to our Beaver Nuggets and our podcast between the Bears and the Bulls. And as always, if you have any suggestions on what you'd like to see from us, just let us know. We want to make sure that the content that we put out to y'all is valuable for you. All right, the last thing I'll leave you with. Do you know what kind of doctor Dr. Pepper is? A physician. We'll see you in August for the next edition of Let's Talk Markets, and don't forget, leave it to Beavers.